Thank you guys so much for joining us this morning. I'm so thrilled to see all of you on a Friday morning at the end of a really intense week. My name's Julia Z. I've been investing in the impact investing space on behalf of clients since about 2008. I'm super thrilled to be here as your moderator, partly because I think it's the right time to be asking some hard questions about what's working and what's not working in the space. We're hoping for a lot of audience participation, so I hope you guys are ready for that. This is not a sit with your email and check your phone kind of session. We're hoping for a lot of audience participation. A couple of notes from the Skoll World Forum. Please silence your cell phones. Apparently at every session there's been a cell phone that's gone off, so if you could just take note. We are going to have a lot of Q&A and a lot of interaction, and so when that part of the session happens, please wait for the microphone because this is being recorded and we can't hear your questions otherwise. And then if you could please, after the session, fill out the survey, say fabulous things. Apparently we're averaging 10 or 20% response on the surveys, and more would be better. And like I said, say fabulous things for everybody here. That would be really appreciated. Okay, so the format that we have envisioned for today is meant to be very exciting and very engaging. The first half, give or take, is going to be a debate, a very lively debate between teams 1 and 2 here. We'll talk about that in 1 second. And then the second half is meant to be a discussion. It's really meant to be like, what is the path forward for impact investing? What can we do collectively to make it better? What are the lessons that people have learned? I'm sure all of you have really interesting experiences and insights to share. So it's probably 35 minutes for the first session and maybe 25, 30 minutes depending on how much our speakers really get passionate and engaged in the conversation. Okay, so the style of the debate is meant to be an Oxford-style debate. And were any of you here last year for the Ag Finance Face-Off? Did anybody attend that? Okay, so that you know what we're talking about. From what I understand, the Oxford-style debate is this. We're going to take a survey at the very beginning on the question of, has the promise of impact investing been overinflated? That's the question. We're going to take a survey. So let's say 70% of you at the beginning say yes, it has been overinflated, and 30% of you say no. We're going to take another survey at the very end of this debate, and if it shifted where the yeses have 60% and the noes have 40%, then the noes win insofar as more people have been swayed by the noes argument. Does that make sense? Okay, so the way that we're going to run then, we're going to take our survey, we're going to have very brief introductions. Everybody's bio is in the program, so you can get a good feel for that, and then we're going to have 3-minute opening statements for each of our extremely experienced and fabulous panel speakers. And then I have a few questions that I have prepared. I'm sure you have some as well, so we'll see how much time that we have. I'm going to be a little bit firm on timing, you guys. Everybody has a lot to say, but don't be like that, Mara. Everybody has a lot to say, but in the interest of fairness and keeping things moving, I'm going to try to be very, very firm on time for everybody. Okay, so let's start off. The question is, has the promise of impact investing been overinflated? If you vote yes, then you think yes, there's been a little bit more hype than reality. How many of you are in the yes camp? Put your hands up high. My goodness, holy smokes. That is a lot of people in the room. I'm not even going to count. Let's do the no's.
Can I challenge the question?
Yes. It's going to be that kind of session, everybody. Okay. Yes, sir. What's the challenge?
You're asking what is the promise. Well, the promise might be,
the promise might not be overinflated if it's promising a lot, but the question is whether it delivers on the promise is really the question.
Right. Right.
It might be a good promise.
So, understood. Okay. So, I'm not going to restate it because this is what's written in the program. Everybody just understand that we're doing this basically to tease out some really interesting themes, and all of your speakers are taking slightly more extreme positions probably than they would in real life in order to make this more interesting and fun for you. So, there were a lot of yeses. Let me see the no's. Impact investing has delivered on what it said it would do. 1, 2, 3, 4, 5, 6, 7. 7 in this room. Okay, somebody take note of that who has the ability. So let's see if we can get some. What's that?
It's really not the right question.
It's the question that was posed to me.
Is it not over? Is it accurately portraying potential? Is the other part of that question.
We're a work in progress. Huh?
We're a work in progress. It's true. Okay, we're going to move on. We're going to move on. we're going to move on with very, very brief introductions again. Everybody's full bio is in the program. So I'm going to start on this side. Chris, would you introduce yourself very quickly?
Yeah, very quickly. Chris West, Brit, obviously. Probably here mainly because I was director of Shell Foundation for 15 years, where I was involved in setting up and managing a number of social enterprises around the world.
Mara.
Mara Bolis from Oxfam, American, obviously.
I've about 20 years in development finance at the Overseas Private Investment Corporation, U.S. Export-Import Bank, at the Middle East Investment Initiative, and in the Emerging Markets Group at the New York Fed, and now at Oxfam for 6 years.
Awesome. Thank you so much. Cathy.
I'm Cathy Clark. I'm faculty director for the Center for the Advancement of Social Entrepreneurship, which we call CASE at Duke University, and also run our impact investing initiative called CASE I3.
Awesome. Lisa.
Good morning, Lisa Kleissner. I am a philanthropist and an impact investor, and I use both capital types to achieve the impact that I want in the world. I'm also the chair of Toniic Institute, and today my remarks are going to reflect a lot of what I've learned from the Toniic Global membership, which is around 360 impact investors going to 100% in impact.
Fantastic. Wonderful. Okay, I'm going to start our opening statements with Chris. I'm putting the timer on. Do you want to come up here, or do you want to just sit right there and deliver? You want to come up here?
I'm a
Okay,
stander,
we can come
so,
here if you like. I'll get out of the way.
Okay. Right, good morning everyone. So I'm going to start by trying to persuade you that impact investing has been overhyped and under-delivered. And I really want to go back to the concept of why did impact investing start? And equally to try and give a voice to the social enterprises who at the end of the day are the ones delivering the impact that we all want. And look, just to make this a little bit light-hearted, and because I'm a Brit, I thought I'd structure the presentation around Charles Dickens as a famous author. So I'm going to start with the ghost of impact investing past, which is in about early 2000s, a number of foundations realised that traditional philanthropy was not delivering the scale and impact and sustainability that we were all after. So we shifted to try and act like an investor with the intentionality to use a diversity of instruments and skill support to try and help for-profit and non-for-profit social enterprises achieve impact in ways that traditional philanthropy wasn't doing. That was the concept. And we wanted to do it in a way that was financially efficient and would generate some sort of return and less subsidy dependence. Now, somewhere along the line, that morphed into you can make money and achieve impact. So that issue of there is a market return as well as impact. If we look at the ghost of impact investing present, what is the evidence that you can have your cake and eat it? We didn't, together with Oxfam, we looked at the research and we could find very little independent research that proved you could have both. So I'll draw back to my own experience of now having worked with a number of social enterprises around the world. What are the characteristics of them? They're selling product and services to people who have either never had them or had them free. They're people with very low disposable incomes, so naturally they're very risk averse to anything being introduced. Thirdly, there's no infrastructure in these markets. There's no distribution channels. So surprise, surprise, it's high cost, high risk, revenue generation, very low and slow. Now let's look at the majority of social enterprises. In my experience, most of them take between 7 to 10 years to even see the sight of cash flow break even. Secondly, their returns when they do approach cash flow break even are very, very wafer thin, marginal, low single digit returns at best. Thirdly, they're extremely fragile to shocks, both internal in changes in team and external in changes of shocks in the external environment. So my suspicion is, therefore, that these social enterprises need smart subsidy, not just to get them through that growth stage, but also in parallel to securing other types of investment, which should not come as a surprise to any of us because most of us come from developed countries. In my country, agriculture, health, education are all subsidised. So this is a duality hybrid system. Now let's turn from the demand side of the equation to the supply side, the investors. Are we matching this up? Now in my experience, most but not all impact investors have limited life funds. They're providing equity, which is a commercial instrument designed for high growth. They have return expectations that are high single digit, low double digit returns. And in times of distress, which is the norm in this sector, the primary motive of investing surfaces. Either the primary motive is I want to maximise impact, or the primary motive is I want to get my financial return back. I've been with a number of social enterprises where schizophrenic boards have nearly killed them because of that primary motive coming out in different directions. So I would argue that there is not a structured response to the needs of the market in growing, and therefore the problem we're facing is how do we provide appropriate finance to allow the growth of social enterprises, to allow them to achieve impact at scale. I think we still by and large live in a binary world. There is grant that wants impact and no return, and then there's other commercial instruments that are seeking a net return on investment with some degree of association with impact. We've got to get out of this binary world. And so for me, let's think about the ghost of impact investing future. Now, I don't have a very good crystal ball, but let me think. If we carry on as we are, I suspect most impact funds will underperform. I think there will be two consequences of that. They'll struggle to raise further capital, and secondly, it will entrench the lack of transparency that's going on in the sector about lessons learned. I think equally, what we'll find is that those funds that actually secure and achieve capital preservation, which is fantastic in relation to the past, will be judged as failures. What a tragedy. And then thirdly, social enterprises will struggle to get through the scale-up phase and will be left with what we all know is the missing middle. Right, Scrooge, when he saw the ghost of Christmas Future, had a choice. He changed behaviour. This is our opportunity now. What do we need in this space? We need more patient capital. You can't go when you're driving a car from first gear to fourth gear. You go through the gears. Patient capital is second and third gears. That's foundations. Thirdly, we need more independent evidence. So to end up, as a Brit, mind the gap. Mind the gap between hype and reality. Thank you.
Very nicely stated, Chris. Thank you very much. You did run over your time, and therefore I'm going to have to do the same for our peers on this side of the fence. I'm going to take the timer with me, in fact, because I couldn't moderate it. Okay, Cathy.
I won't see it.
Cathy Clark, please take it away.
Great. So I want to make the point that I think impact investing is not only real, but has real opportunity over the next decade to change the way the world invests. And we don't want to miss this opportunity. Data, first of all, tells us that the amount of capital that is aiming to have impact is steadily increasing. As an academic, I can tell you that. I can quote the figures if you want more information, but we know things like 1 out of every $4 that's managed professionally in the United States is now screened for sustainability, responsibility, or impact. We know that the privately owned portion of the market that the GIN surveys is now over $15 billion. And it's easier and easier for people to raise capital. That's not even including Giving Pledge members, DFIs, foundations, and other things. Demand by investors is growing significantly. There are two groups who are constantly surveyed and say, we want more of this, baby boomers and millennials. Millennials for the past 5 years, when they say, what is the primary purpose of business? They say to solve social problems. And therefore, they're very interested in thinking about how they can use their cash to do this. This is not going away. In fact, it's an opportunity to harness the interests of this new generation. And I feel like we have about 10 years to get this right. And the vision that I think is exciting so many people in this field that I actually don't think was possible even 5 years ago is that everyone can be an impact investor. And as Matthew Weatherly White has often said, this can be an opt-out choice as opposed to an opt-in choice. And I feel like all of the people in this room who are trying to make social change, we have to try to make this real. We have to try to turn capital towards good as much as we can to get the problems that we have to have solved. Luckily, what we have is a market that's at an incredible inflection point. We have more actors stepping in to help do this work than we have ever had before. With an impact lens and trying to figure out how to bring intentionality and accountability either to what they were already doing or to start new activity that brings those two habits. We have a picture. I don't know if I can click here to show our slides. There we go. We have a picture of the market. We were talking about supply and demand that we use when we teach entrepreneurs about capital. And there are, you know, hundreds and hundreds of new capital sources, many new kinds of capital channels and intermediaries that didn't exist 5 to 10 years ago. And then, of course, we have impact organizations. The most important thing on this chart for us, I think, to understand what the bottlenecks are in the middle, in investment vehicles. And that is that the strict mainstream ways of creating funds that using debt and equity often do not work for every kind of impact that we are trying to portray. So what's happening in the marketplace is we're innovating. And we're developing blended capital, catalytic capital, different kinds of revenue-based financing, pay for success. Like, there's just this incredible proliferation of people trying to attack these problems to get this right. And I feel like we do not want to throw the baby out with the bathwater as this is happening. The other exciting thing to see is that this is such a big tent of activity. And I just want to show you one more, and then I will wrap up because Julia's approaching. Which is, and we can talk about this later, but this idea that impact investing is appealing to people because it is a broad concept, but underneath it is a lot of completely different activity with different goals. So one of the things that we did last year with Omidyar Network and some partners was kind of say, how would you actually parse this field? I would posit that a lot of your very good comments, Chris, are really around what is hard for targeted investment. But the truth is, this vision of everyone becoming an impact investor, no one is going to put 100% of their money into targeted investing. What people do is look at it from a portfolio lens and balance the different kinds of investments. And that's why I'm going to be very pleased later for Lisa to take over and talk to us about the portfolio view.
Excellent. Thank you so much. This is thrilling, right?
Thrilling.
This is thrilling. All right. Mara, take it away.
Hello. I wanted to preface my comments by saying that they draw from my personal experience setting up Oxfam America's first impact investing fund, and as chair of Oxfam International's group, that informal group that focuses on investment and investment-like approaches in terms of our implementation in the field, that spans 7 different initiatives, 4 or 5 different affiliates. And in those initiatives, what we do is we focus on businesses that most conventional financial institutions consider uninvestable, yet can have a significant impact, positive impact on people living in poverty. And I'd like to quickly give one example of such an enterprise. The enterprise is invested in by Oxfam's Enterprise Development Program, and it is called Shekinah, and it is in Rwanda. Shekinah was started by a Rwandan entrepreneur who, after he visited a market in his village, saw that the women who were selling the cassava leaves were throwing them out at the end of the day. And he asked why, and they said because cassava leaves are highly perishable and there was no purpose taking them home with them. If they didn't sell them, they had to throw them out. So he did some research, and what he found was that by drying cassava leaves, you could preserve them for up to 2 years. When dried cassava leaves are cooked, they are as tasty as fresh cassava leaves, and they remain highly nutritious. So this was the start of Shekinah, which now is a small enterprise in Rwanda that dries and markets dried cassava leaves, working through local collection centers where 1,000 plus farmers now supply their cassava leaves and sell their production. Farmers that sell to Shekinah are paid by mobile money, which I think we know and we can all agree is more reliable and safer than cash. Oxfam worked with Shekinah to provide a loan and technical assistance, both to upscale various management capabilities, but also to increase the intentionality in terms of bringing women into the market in a very intentional way. Now, why do I bring this up? I bring this up because my question for you is cassava farming in Rwanda what comes to mind for you when you think of impact investing? Or instead, are the images that your mind's eye arises, do you instead think of investors eager to align their values with their financial futures and those of their grandchildren. Or maybe you think of Bono, and you think of TPG, and you think of the Rise Fund. Or possibly you think of Goldman Sachs and Merrill Lynch and wealth advisory fees. This is unsurprising if those are the images that you see. Because in my perspective, what has happened is that the focus has remained very squarely on the needs of the investors without sufficiently taking into account the needs of the entrepreneurs and people living in poverty. The supply and capital fixation, I happen to believe as American, reflects, at least in part, American values that fetishize finance. The size of the market has become an indication of the success of the market. And while there is no impact investing without investors, there is no pipeline without social enterprises. And in fact, that is what we're seeing, right? The 2016 GIN survey, in it, 82% of respondents cited the lack of high quality pipeline as critical to holding back the field. And my question to you is lack of pipeline the real constraint? Or perhaps has it been unrealistic expectations about profit and time horizon that are constraining pipeline, and increasingly so as the market mainstreams? What are driving these consequences of the supply of capital focus? The worry is that as funds seek investments to fulfill the promises that they have made to the investors of market or near market return, that they will increasingly look at conventional emerging markets financing in broadly positive sectors, such as telecom, hospitality, and healthcare. It should not be assumed that an investment in a cell tower or a wind farm or any other enterprise in the global south is inherently poverty reducing. Rather, it should be incumbent upon the fund to demonstrate how these enterprises are structured to benefit the poor and marginalized populations and minimize the risk to those populations. As this trend continues, enterprises reaching people living in poverty will continue to lack appropriate finance. If you compare the cell tower to the Rwandan enterprise, what I am here to ask is, does the Rwandan enterprise continue to have a home in this field of the future?
Woo. Mara Bolis. Wow. Okay, Lisa. Let's respond.
Okay. Well, thank you. Let's see, I'd like to share some of my own observations on this space. Last year I participated as the editor of a report, and I brought a copy of it if anyone wants to see it, where we looked at the practices of 100%ers, folks who are taking all their assets and moving them into impact. And to your point, Cathy, those who are taking a portfolio approach, like my husband and myself, we invest across a wide spectrum of risk and return. And so it's not about double digit. It's not about mitigating a total low risk. We're doing high risk, low return. We're doing high risk, high return. We're doing a low risk, high return. We're doing a whole combination of things. And we're doing this globally. We're doing it directly. We're doing it with funds. We're experimenting across the field because that's our job as investors. We are doing this to really stress test the system, and we're being absolutely transparent about all the work we're doing. So we're not the only ones. This report is this is 51 other portfolios that are being transparent about their work. So I'm going to rely on that data with my storytelling. So I want to set some context about what I believe. And by the way, I don't subscribe to ghosts. I'm more of a pragmatist. I work in the real world. No ghosts involved. So impact investing as a field is a work in progress, no doubt. This is not for the faint of heart. This is for somebody who's willing to take that risk, roll their sleeves up, do the dirty work, have a few tears on the way, and have a few successes. It's not easy work. Philanthropy, that's why my husband and I do it together. Philanthropy has a deep history. I'm a philanthropist. I personally don't have a deep history because we only came into money in 2000. So, but I've worked really hard to try to be as leveraged as I can. And in fact, some of my peers are in the room in philanthropy. And while philanthropy has made great progress, guess what? It hasn't solved for poverty. It hasn't solved a lot of the systemic issues. And so I subscribe to the genius of Anne. And I come from a background of small family business. That's where I got my business acumen. And I took that acumen and put it together with thinking about small and growing businesses. And so I actually work very directly with enterprises to capacity build them, and then we invest in them. And we do that. We've done that in India. We're doing that in Central and Eastern Europe. We also are doing it in my home state of Hawaii. And that's where I get really grounded in knowing that actually it's an and proposition, not an or proposition. So I'm going to really quickly race through this. How many more minutes do I get because Mara was over? Another oof. Okay. Oh, go to my, let's see if we can go to, no, one more. Sorry, which one is it?
That's it, you got it.
Oh, so this is my world. You can see all the themes, the impact themes in the middle, and you see the asset classes on the outside. And what the idea here is that you can actually target themes across asset class successfully. And I'm going to give you an example of, so that's number one. So to refute this idea that you can't do it, you can. And also you see poverty alleviation is 12% of that investable universe here. The reason it's a small number is because there aren't that many investments in that sector that are investable. Many of them lend themselves to grants. That makes a lot of sense. We also use our grants for that. So I'm going to give an example of one of our investors who did a really interesting structured deal. You know, the idea that we're kind of bifurcated, black and white. No, we're actually in the middle. John Fullerton. He was invested in a farm, New Day Farm. And what happened was there was a crisis where the farm capital structure, or the infrastructure, imploded during a severe storm. I think it was an ice storm. And they lost their whole crop. They lost their equipment, everything. And a hostile, one of the investors, early investors, came in with a hostile bid to take over 70% control of the company and basically wipe out everybody, including the founder, in terms of their ownership. John was like, this is not going to happen. So John came in, he put in an alternate bid, and he managed to fix the financial, restructure it, and instead of blocking everyone out, he invited everyone back in, including the founders, to have a very healthy share of the company, the founders, the employees, and guess what, the hostile investor too. And so it's a very community deal. This is the community I live in, the investors that I work with. This is how they think about investing and structuring. So I'm going to give you one last example, and that's that if we're going to solve for global systemic change or problems, it's going to require collaboration. Heron Foundation, great example. They discovered that their programs targeting poverty were important but not sufficient. And so they've taken an and approach, and they have, and their whole goal is sustainable job creation in the US. So they've completely revamped their portfolio and actually hit the 100% target last year. And today they're successfully investing in both for-profit and non-for-profit, very similar to what my husband and I are doing. Today I was privileged to be at the breakfast with Darren Walker, and Darren said something I think that basically for me just sums it all up, and that is the only poverty we really have is poverty of imagination. And I think impact investors have very vivid imaginations and are putting that to work. Thank you.
Thank you so much. Those are electrifying opening statements. And note to Skoll, 4-minute opening statements are better than 3. I'm a little bit mindful of time. I have a couple of questions, but I imagine this audience has a lot of questions. I want to make sure that this is most useful to you. So I'm going to just simply start with one question, and that is, I believe that the argument that this team is making is simply that most impact investors need to know what they're trying to achieve. They're taking a full portfolio approach, and that there's one segment of their portfolio that should be invested wisely, slowly, patiently, with lower growth in the segment that you're looking at. And I wondered if you'd like to respond to that from your research and background, if it's in fact the investors that are at fault in this sector, or is it perhaps our entrepreneurs that need to be more demanding about the kind of capital that they use, the kind of partners that they partner with, the sort of structure that they create for their own fundraising?
I'll have a quick go. Just as a preface before I say anything.
Of course.
Isn't it interesting in the context of Skoll Foundation, where I think it's sort of bringing people together, that here you've got someone ex-Shell Foundation collaborating with someone from Oxfam, arguing over... Isn't it kind of interesting? Anyway, to answer your very sensible question, Julia, look, I coming from a business background, businesses do not survive unless they give their customers what they need. What I'm worried about is happening is we've got a disconnect between what the market of social enterprises need and the supply of support skills and capital that they need. It's not a question of blaming anyone. I mean, going back to my analogy about gears in a car, you need all gears in the car. It's not a problem. I've got no problem with investment. But what we've got to do is we've got to match the type and nature of support, skills and investment to the stage of growth of the recipient. That's the disconnect at this moment. No one's at fault here, but we've got a gap. That's why I use that mind the gap analogy. That's what we've got to do. So of course Lisa's right. Of course we have to diversify. Of course we have to innovate. But we won't do that if we keep being self-congratulatory about how well we're all doing. That, for me, that's the whole purpose of this debate. It's just try and think, are we getting it right? If not, what do we need to do? No one's at fault here. It's, are we structuring this right?
And if I can just add to that, I think what doesn't get raised enough from my perspective, and what I've heard a lot from social entrepreneurs, is that that they are there's a asymmetry of information, right? Social entrepreneurs are not as well informed about their options, about their the financing vehicles that could be helpful for them. What they are very, very well informed about is their toilet or their cassava leaf, right? And there aren't social investment banks at the moment that help guide them through the process. So my suggestion within this is that the field needs to shift in attention towards that side of the demand-supply equation. And because this is money that is trying to do something profoundly different, it should behave differently, more democratically, more equally, more honestly, because we all have the same goals and the risks are too high.
Did you want to address that? Because I have a different question for you guys.
I actually really want to address
Please, Cathy. Please address that then.
And if you could put up that blueprint to scale slide for a second. So, which is like 3 in, I think.
This one?
Yeah. So this idea of helping empower entrepreneurs because they need to understand what's right for them, and investors need to understand, how to find the right deals. Completely agree with what you're saying. And I don't know whether we need investment banks for that or we simply need education. So this is taken from a new product that we have been experimenting with for the past 2 years. It's called Case Smart Impact Capital, and it's a set of online tools based on videos and experience from many entrepreneurs and many investors saying, what do you need to know and what do you need to do to get to the best deal for you? And so one of the things we do is we take the monitor model of Blueprint to Scale and say, what are the particular kinds of challenges that you actually have to answer at each stage of development, and what is the capital that is aligned with those questions? And this is based on not only our 10 years of work with impact investors, but our 5 years of work over the past 5 years of work with working with global health entrepreneurs in serving low and middle income markets, who were actually finding that investors and they did not understand the different phases of work, and therefore we're disconnecting. So I feel part of this is an information problem, but we actually have the experience. So what we've been doing is organizing that experience, and I actually feel that a lot of this will solve much of what you've been talking about.
Can you put the butterfly up, please?
The butterfly up?
The butterfly is also from our tools.
Yes, the butterfly.
Yes.
Notice the butterfly's body. So, this idea that we're sitting on one side, we're either in philanthropy or we're in the for-profit markets is really not the world that I see. I see our peers have very happily romping in the gray area, creating different structures and experimenting. In fact, the demand dividend that you see up there, John Kohler, who's a board chair of, not the board chair, I'm the board chair. He was the board chair. I'm now the board chair. John Kohler's on our board at Toniic, and he wrote a seminal paper on demand dividend and also created a tool, an online tool that if you're an entrepreneur, you can log on. It'll teach you about the tool, and it'll help you structure with a kind of a Q&A decision tree to create a contract.
And to add to that,
Yeah.
I am an advisor to Capria, which is an accelerator for new impact funds. Many of those new funds are built
Yes.
on the demand dividend and revenue-based financing model. So we're taking an innovation
Yes.
that someone found an entrepreneur needed, turned it into a toolkit for investors, and now turning it into a fund structure that we are now replicating around the world.
And so the
This
answer is
is
yes.
working.
The answer is yes. The answer is yes, that. In fact, everything you say is true, that if we're going to use only the tools from the for-profit industry or only use the tools from philanthropy, it's not
too
going to work.
limited.
We've got to create, and we are creating, and that's why we have to work together to do it.
And I want that to be one of our discussions later, because the idea was that after we finished the debate, we would have a much more nuanced discussion about the way forward. So let me hold on to that and ask you guys one more question before I open it up, and prepare yourselves. We have time for one or two questions from the audience. But I wanted to talk to you about the impact part, because I feel like a big gap in the industry is it's relatively easy to report on and measure financial returns. It's quite hard still to measure and report on the impact returns. And so I think that's been a criticism to date. And I'd love for you guys to share from your experience, how are we reporting? Is the mainstreaming of impact investing sort of losing the focus on the underlying impact and the work that we're trying to do? And how are you sort of focusing on that in your work as impact investors?
I'll go first.
You go.
Okay. So yes, the impact management piece has been lagging in the industry, and there's a reason for that. I feel like we're the whipping boy, girl, woman, man of the philanthropists and of the for-profit industry, because we sort of sit in the middle, and the for-profit guys say, hey, you're just philanthropy disguised as an investment, and then the philanthropy guys say, no, you're actually a shark trying to disguise yourself as a do-gooder. You heard Bono. Mm-hmm. But the reality is quite different than that. We were pushed to the wall to basically demonstrate the return part of it. And honestly, we didn't get into impact investing to do that. We got into it because we fundamentally believed that it was possible to do both. And we were willing, actually, to take a haircut to get that done. Because for us, the money we had was more money than we ever imagined we would have in our lives. Therefore, we were willing to take more risk to do it. What was really miraculous was that we actually made money doing it, even though the intention was full, honest, integrity, high integrity impact. So that was the first exercise, proving the financial returns. And then we turned our sights. We were collecting data on the impact, but I can tell you the tools are really rough. Mm-hmm. And we test drove. We were early adopters of IRIS. We looked at gears. I can tell you when you look at an IRIS data chart, your eyes cross and you're just like, where's the impact story? And so when we realized that wasn't going to do it, we've been experimenting with more tools. And right now we actually hired a third party to come and scrub and look at our portfolio all the way back to the beginning and log the impact. And there's more impact than just your portfolio. There's impact in the advocacy work that we do. There's impact in the work that we're doing with accelerators. And so we're working actually with intermediaries, with investors, and with investees. Because if we don't work with all three, and at the time we entered this space, that ecosystem really was barely threadbare. And we've been working on making it robust, like many of you in this room here. And so we are, I just want to underscore, we're a huge work in progress. And so impact, the measurement of impact also. But I want to also add that I've had some amazing conversations here at Skoll this round with folks who are on the front lines, like Clara and a number of other folks who are looking at very innovative ways of, what I'll say, identifying the characteristics of impact so that we can begin to map some of these characteristics across a portfolio. So I'm excited about what is going to happen in the next 2 or 3 years. Excellent. On this.
So I want to have one or two questions that are squarely focused on swaying your opinion on the debate here. Does anybody want to ask something of one of our teams that may or may not change your opinion about this question? Because we're going to get into more of the more nuanced discussion about impact investing at the end of the debate. Anybody? Does anybody want to raise a question? Yes, sir, right here in the front. Can we get a microphone? Thank you.
Hi. So one point that I found powerful was Mara's point that we need to make this more democratic. And the whole notion of investing is inherently undemocratic. We have a needy community and an entrepreneur who needs money from the investor. And what I hear from the other side is a lot about their goodwill. But goodwill doesn't really quite square the democratic problem. I hear a lot about goodwill and good intentions, but I don't hear a lot about how exactly is the democratic need of hearing from the people who are receiving the investment what their place is in your investing. What do you learn from them, as opposed to statements about your goodwill, which we totally believe, but I'd like to hear more about that.
I guess I'm on the hot seat again. So actually, it's more than goodwill. The reason we work directly with folks like who Mara works with, why we work directly with accelerators, is for that very reason, because that's where you're really going to see very granularly what the needs are. You're going to be able to work with them to explore where are the gaps in their business acumen that are holding them back from realizing their full potential as an entrepreneur and achieving the impact that they can or should be able to achieve as an entrepreneur in whatever area that they're focused. So, what interesting thing I learned about our network is that probably more than 50% of the folks who are in the network are engaged in some way or another with accelerators and or incubators globally. And so it's just like, you can't really, my feeling is I'm an architect, that's my background training. I don't think that and I then became a manager, but I don't think I could become a manager in an architectural firm if I hadn't been on the boards in the first place to learn the nuts and bolts of that business, to be able to then manage to drive a process to help design and do buildings of 400,000 plus square feet, which is where my career took me. So, and I'm 62 years old now, and I've been working, I came from a family business, so I've always been very hands-on, and I've spanned this hands-on to the kind of more strategic level thinking in the way we approach the work that we do. So I don't think it's an either or. It's not just about intention. It's about we do roll up our sleeves and we're working on the front lines to really deeply understand it. So one of the tools I think that has been developed in this, and that came from Acumen, and that's the lean data, where you basically go out to your customer or your beneficiary, and you're going to get frontline data points on are we having an impact there, and is this meaningful intervention to you? And Clara Barbie, one of the things she's talking about doing is taking that tool and going through, taking an investment, and not just looking top line at the beneficiary, but going through the whole value chain inside that business to explore the lean data, take lean data and see if you can distill the data out to really get to the granular nature of the impact.
Okay, I'm going to move on. Do you guys have a response to that question in any way?
I think just quickly. Oh. I think
I'm going to start using that strategy.
it comes from the BBC interviewer who had the child running in, and she's
I know it. Another good story.
So funny.
Another good story.
So I think what I'm suggesting in this is that those that have the capital, and the way that I think that you are rightly doing, just imagine yourselves in a position of tremendous power, right? And be sympathetic. I feel like the space, and which I think you're doing, I'm not saying you're not, I'm really not, and understand that we're operating in an inherent power imbalance in this relationship. And be sensitive to that, because I think social entrepreneurs are it's very difficult to navigate that and be honest at the same time, I think, from the social entrepreneur perspective, and be honest about the risks that you're concerned about for your constituency, which are the vulnerable populations that you're seeking to serve. So the more that we can level that power imbalance, I think the greater success there'll be in this field, and I think you're doing that.
So if I could just, we're going so quickly through the time here. So I'm going to call you on that a tiny bit. I feel like for those of us who are early into the impact investing space, we had a basic premise, which was more capital invested with intentionality would eventually lead to more impact. And so the thesis was you had courageous early high net worth individuals who were investing in the space, and that would be then followed by foundations and endowments and retirement funds, and that if we could move trillions of dollars to solve some of the problems that we're all interested in, that would be better, essentially. And so I'm a little bit worried, frankly, by the Bonos of the world who are coming out and saying not only that there are good people doing bad deals, but that there's a lazy-mindedness. This was his quote in the New York Times in December of last year. There's a lazy-mindedness about the do-gooders, which frankly hurt me to the core. When I read it, because I feel like impact investing is better investing in many ways, right? And so I'm a little worried that if we're sort of coddling, perhaps, our entrepreneurs and not giving them enough credit, that we're doing a disservice to the industry. So insofar as I feel like entrepreneurs should be expected to demand more from their investors, no?
No, I mean, no, but, look at where are we coming from? We're coming from okay. I think that this is kind of the misunderstanding that somehow what we're suggesting is something sloppy and lazy, where I think that I celebrate the discipline and the transparency that comes within this space. I think that that's absolutely a huge benefit. We know that there have been major problems with this strictly grant-based approach. That said, there is a higher purpose here, and we should be operating as partners and not in an antagonistic power dynamic that I think can lead people off track in a way that's very dangerous.
Okay.
But you know what? Do you want to say something?
And I know Chris has something to say. I'm a little bit mindful of time, and what I would like to do is I would like each of you to have a closing argument, because we are, at the end of the day, we're trying to sway the audience here. We're trying to sort of win a debate, as it were, sort of theatrically here. So if all of you could spend, say, 2 minutes with a closing argument to try and sway our audience, we're going to take our final survey, and then we're going to have more of a conversation, I think, with our audience here, if that's okay. Chris, can I start with you again then?
I was looking away. Final argument. Look, some of these social entrepreneurs are trying to tackle some of the most difficult challenges in the world. They're systemic challenges. They're there, and they're big problems for a reason. It's not because lots of bright people haven't looked at them before. What we need to do is help them in a way that actually allows them to succeed and generate lasting impact at scale. And I think I think the Media Network did a very good report where they talked about, as Lisa's quite rightly termed, a spectrum of risk, return and impact appetites on the part of those funding them. I totally agree with that. We need diversity here, and we need flexibility on instruments. The only thing I would say, having worked with social entrepreneurs, is that there's equally a continuum of behaviours on the part of investors. And going back to your point, I've been with some investors who have almost killed social enterprises because they've forced the pedal down on financial returns at the expense of impact. And that's really upsetting when we're on the brink of really tackling some of these big problems. So there is an underlying behaviour issue. I'm certainly not implying that on the other side, but we need to be more open about this. People are doing it for different reasons. And everyone is needed. But I keep going back to my analogy of gears. All the gears in a car are needed, but we've got to get them in the right order, and we're missing a bit at the moment.
Thank you so much. Mara, closing statement.
So I'm not suggesting that we go back to 1970. That is not in my interest. I get the improvements that financial sustainability and the discipline and many of the knowledge that the investing field brings to this space can confer. But as I said before, because this field is trying to do something different, it should behave differently. And I suggest to you that we increase the focus on the entrepreneurs and the benefits and potential risks of the investments that we are making onto people living in poverty, in the design of fund structures, in the design of financial instruments, in the determination of the impact thesis. They should be brought to the table as partners in determining these things. Democratize the process, not to coddle, but instead to be better informed as investors. We should be more honest, more empathic than the conventional, I'm not saying that you are, but than the conventional financial markets, right?
Yep.
more equal than conventional finance, and invest in independent research. The Said Business School review of the social enterprise markets found that 88%, I think, of the research that was published was focused on the investor audience, and some great majority of that was focused on growing the size of the market. Where is the investment in looking at the social enterprise side on independent research outside of the market to try to get a more fuller appreciation of what's going on in this space?
Thank you so much. Cathy, closing statement.
Yes to what she just said at the end. And
yes.
We have a whole bunch of plans around that, which I'm not going to talk about right now. But
we want to hear about them.
I actually think there's a lot of agreement between these two sides. I think what worries Lisa and me is overgeneralizing one piece of the market to the whole market.
Right.
And so I hope when you consider your final vote, you're thinking about voting about the whole of impact investing and the potential for the whole. So, you know, when Jim Kim basically told us on the first day, he has insured the planet against pandemics by using innovative finance. That is amazing,
yes.
right? That's the kind of innovation that this field is pouring forward. Is it true that entrepreneurs are disempowered? Yes. Is it true that we need different kinds of innovative structures to deal with them, and we need clear-sightedness about intentions? Yes. Is it true that we are all bungled up because all of the different categories of what we're doing are mixed up and squished together, and then we don't know what the appropriate accountability tool is for that particular goal? And we're working with Bridges on the impact management project to align these classifications with that so that we can actually build some infrastructure here that's going to make all of this easier. If we do that right, and I think we actually are, and I think that the notion of patient capital, we also need patient ecosystem. We as an ecosystem need to give ourselves credit for where we've come and keep driving forward.
Nicely said. Thank you very much.
Yeah, I agree. Oh, gosh. I would say there's a lot that I agree with, and I do see the bad actors in the space. I think that's the reason my husband and I in the Toniic group are really working hard to turn that around and not have that as their practice. I don't see a lot of people patting themselves on the shoulders in our world. I see people really worried and with a tremendous sense of urgency that if we're going to get this right, to your point, we've got to get this right in the next 10 years. And a big part of it is the impact metric piece, which has lagged, and without it, we don't have a guiding star.
That's right.
So I think, and I'm going to say, it's not just our problem, but it's also philanthropy's problem. We both have the problem that we haven't been measuring, even targeting the right metrics. And so I would love to work together with you collaboratively on that. So thank you.
Thank you very much. Nicely done. Thank you so much. Really excellent argument. Thank you so much. Okay, let's take a vote. I think we'll just do the people on the no side. That is to say, how many of you believe now, perhaps, that impact investing is, in fact, meeting its sort of promise and it's kind of, how do I want to state this proposition? That it's, what's that?
I think it's still the wrong question.
It's still the wrong question?
It is the wrong question.
Oh, well, we can't change the whole proposition now. We can't change the whole proposition now, but or you have to stick with the original, and we'll get into the nuances in our discussion. So the original question was, has the promise of impact investing been overinflated? How many of you are still yeses? Oh, I feel a change. I feel a shift. How many of you are no's now? Look at that. The no's have it. Very nicely done. Very nicely done. Very nicely done. Very nicely done. That was very exciting. And I just want to note for you, by the way, Chris and Mara's paper has recently been released. It is entitled Impact Investing, Who Are We Serving? I would recommend that you take a look at that. The other piece
on Oxfam's website.
On Oxfam's website. The other piece that might be interesting for you, Omidyar Network released earlier this year something called Across the Returns Continuum, which addresses a lot of the issues that everybody has discussed here, and it essentially talks about how you need to look at different structures, different models for different types of investments and different issues that you're addressing.
And since you're pitching.
Oh, and while we're here, the Toniic has produced launch report. Is this available on your website?
It is available on the website, and it's the research that we did on the 51 portfolios going to 100%. And much of the data that I referenced is in that
Perfect.
report.
So we have all kinds of great materials that you can look at now. Wonderful. Okay, now that the pressure of the debate is over, let's open this up. We have about 20 minutes. They're very firm, by the way, because the closing plenary is at 11:45, so we must be out of here at 11:15. So we have some questions. If we could get the mic down here. And I think what we're trying to achieve, by the way, before you even start your questions, I think what we're trying to achieve is either to tease out some of the more nuanced aspects of this and or to come up with sort of some of the ways that we can address these issues on a go-forward basis. Please.
My name is Eriko Ishikawa. I'm from the International Finance Corporation, which is part of the World Bank Group. So it was really great to see Jim Kim involved finally. Yeah. I've been coming to Skoll for many, many years. I am a great supporter of social entrepreneurs. I have worked with them myself directly. I created my own team at IFC just to look at precisely what impact investment is, right? Question. Why have not we seen more of the incubated social enterprises getting financing from the IFCs? We have done things with Shell Foundation. We have done things with Acumen, with co-invested. Not as much as I think that's where the frustration is why hasn't it scaled to the point where I can put in $1, $2, $3 million? You know, I just had 2 weeks ago, we issued a social bond, $500 million, AAA IFC, to go towards inclusive businesses, which is businesses that are pro-poor. Now, I want to see that part of IFC grow, and I always hoped that it would come from people who are here, that would get them, the social entrepreneurs, to accelerate and to get to the point where they can really need that kind of financing. So why is that not happening?
Do you guys want to start with that, Mara and Chris?
Look, the problem is this classic missing middle that I was referring to. I think it's kind of interesting. If you look at what I would say are genuinely regarded as the successes in the social enterprise space, and I should imagine that the fingers on both hands there. I mean, Root Capital would be one, and D-Light on the energy side, and so on. Yeah, I mean, it's a shame Willie's not here, but what you'll find is that they are still marginal return, depending on subsidy to do the excellent things that they're doing. So, will they meet your finance requirements? I doubt, unless, exactly what Cathy said, unless we're all smart and we try and do hybrid financing, where that's where we need to get to, and then you'll be able to do it. But if you go in with just a blunt instrument, and I completely agree with Lisa, this is not about a philanthropy versus for-profit world. It's about how do we blend these instruments in a way that is appropriate to the stage of growth of these enterprises. But there aren't that many lighthouses at the moment. We cannot forget, this is tough. This is tough. I've started my own business. Anyone who's had a business in here knows it's tough doing a start-up growing business. Social enterprise, it's a whole new different ballgame. This is tough. So we've got to be patient, we've got to blend instruments, and I suspect you as investors got to look at your terms, because, sadly, you're one of the investors that nearly brought down one of our partners because of your terms.
Ouch. Another question down here, please. Hold on one second.
Nigel Kirscher, chair of the Big Issue Group. So I sit on both sides, both as probably the most successful, a well-known social enterprise in the UK, but also, we've launched our social merchant bank. We manage and advise on about 150 million, right through from early stage to loans to LPs. And I want to come back to the democratising, and that's going to be the question, to retail funds. So we launched the first daily tradable UK social bond fund with Threadneedle 3 years ago, 100 million now. We're launching in June with Standard Life an equity fund on inclusive jobs, and we're talking of an infrastructure fund. People say, what's the direct impact? What's the social impact of those funds? Well, I think it's about democratisation of capital. I think it's about changing the hearts and minds of people. So when our bond fund was put on the Scottish Widows pension pick, and millions of people could say, yes, I can put my pensions and my savings into something that's finances doing something good for this country or wherever it is. I think it's a key about how not just the direct impact of social entrepreneurs, but it's changed the hearts and minds of people, because that's in the end is going to create the changes I think that we're going to see.
Is that what you meant by democratization of capital?
No. I was just using it as an excuse. Those that know me will know.
Less about like hearts and minds and more about like mechanisms and that make things more democratic.
So,
well, we didn't talk about B corporations, which is one of the most obvious, you know, novel ways, it's now about 10 years old, to try to bring this idea of democratization of stakeholder input into the actual boardroom around decisions that are made about a company, and to actually protect it from undue investor dominance in the, you know, the mainstream definition of fiduciary responsibility. So I feel like we actually do have, again, these new ways of really thinking about how structure aligns with purpose. And it just takes time for them to be adopted.
Can I just give a quick example?
yes, and then I think there's a question over here somewhere.
RSF social finance in the States, and my understanding is that RSF prime is defined, the rate at which they lend is defined by a multi-stakeholder approach that involves both the entrepreneur and the investors and staff. And so I understand that that's a difficult dynamic to scale, and if you're working at a distance and geographies and everything else, but just that sort of idea of the discussion and the leveling.
We have a case study on that on our website if you're interested, ksr3.org.
Could we get a microphone over here, please? Yes, sir.
Yeah, I guess one thing I'd like to point out is it's incumbent on the entrepreneur as well to do a lot of level setting and finding that initial experienced impact investor to say, all right, we need to really make a plan, right? And just as you say, there's a ton of capital available. Sometimes it's not actually true, right? It's about figuring out what it is, and you're not finding yourself taking capital that just presents itself, and actually just saying, just you know, you guys, frankly, in this maturing industry, saying, listen, dude, you got to slow down for a little bit because we got to find the right person to help you out, or else you could be screwed in 7 months because they're going to expect you to do something that you're not ready for. And so entrepreneurs needs the coaching from exactly the folks that are probably in this room to say, don't take that money right now. As alluring as it is, and as much pressure you're putting on yourself. So I'd say one of the structures is saying, all right, entrepreneurs, you know, make sure you know where your capital wants. And you have more experience than the entrepreneur. I mean, you know, I've done 3 ventures, right? But that's a lot in the world of social entrepreneurs that might be in their 20s or even in their teens. So I leave it with that.
Well, I do think it seems to me like almost every business school now has some kind of a center for social entrepreneurship or social innovation, and they are training the next generation of entrepreneurs. I know that Cathy and her team are doing great work, and so I think that is part of addressing that part of it. Chris.
2 quick things. To any entrepreneur, choose your investors like friends carefully. And secondly, I think the transaction cost between trying to find the right capital is inordinate, especially if you're based in Nauru or in Togo or anything else. So clearly we need ways in which we can get into some sort of merchant banking to reduce those transaction costs. But choose your investors like friends. They'll screw you otherwise.
Could we get a microphone over here, please? Over here, please. Thank you. Wait, hold on. You have to speak into the microphone. Okay. Sorry.
Thank you. Stephen Harp from the MasterCard Foundation. As reluctant as I am to try and reduce everything down to one number, given the complexity of the issues that have come up here, no one's really mentioned return expectations. And I think that goes to the core of some of the concerns, i.e., Chris, you mentioned patient capital. So that's the second dimension is the time horizon.
Right.
But would it, if we added this dimension of return expectations and time horizon, would we reach agreement? In other words, let's not talk about 20% returns. Let's talk about high single digit. And let's talk about what is patient capital? Is it 5 years, 10 years, 20 years?
So if I could just maybe give a little bit of context to that from some work we did a few years ago. So
is that in here?
It's not. 4 years ago, we set out to say, what are the practices of high-performing investment funds? And we defined high-performing as meeting or exceeding their investors' expectations around both financial return and impact. But we were open. We didn't say market rate or market benchmark. We said investor expectations. That work looked across the field, ended up doing in-depth analysis of 12 funds who ranged from a return level of 0.12%, which was RSF, whose investors were thrilled because they invented that rate themselves every quarter, all the way up to Elevar Equity, which had a 23% return rate. And so what we were trying to show is you can enlarge the notion of what market rate is if you listen to investor intention and be a little bit broader. Now what we have, of course, in the financial field is we have all this asset class stuff, which is how people make decisions. But I think the most important thing is to realize that it's a very broad continuum of what people will actually accept.
Do you want to speak, Mara? Is that why you're poking me? But before you even speak, and can I also just note, I thought you were going to talk about the report that you and Tideline co-wrote about the different asset classes and the return and risk expectations and mapping impact into that, which is actually super fascinating, which we might talk about later. But Mara is poking me.
Yes, but we also have introducing the benchmark by the GIN and CA.
You're just hating on the GIN today.
That sets expectations that are pretty consequential and only focused on those funds that were seeking market rate returns. So this needs to titrate, right, between your input and
that's where I think what Julia was talking about, which is, again, we have to segment the market. When Gin and Cambridge put out that first release, I think they did it at the Andy conference. I don't know if Randall's still here, and they accidentally overgeneralized, and they said, we have just learned that impact investing can be market rate. And the whole community actually rebelled and said, no, you have just learned that a small set of funds who are using private equity to achieve market rate returns did so. And that is only one segment in the larger universe. And we have to be careful, and we need more research. We don't know the returns of the other
Your work is so
segment.
important. Yes. That's why your work is so important.
Can I just add?
Yes.
So that's institutional. So our investors range from single digit, the smallest portfolio is 1.6, up to a little over 600 million, sorry. And in that range, the return expectations that people have, that they consider what they're determining to be market, range from 5% up to, and this is net of fees, et cetera, 5% up to, on a fund that's a little bit more narrowly focused and not across all asset classes, it was double digit and 15%. We're not seeing, on a portfolio approach, we're not seeing these wild double-digit things that you reference in your paper.
So important that you're making that transparent. That's critical.
Yeah.
I do think there's a little false dichotomy that's set up in the market. This whole do you have to take concessionary returns in order to do this kind of work? I think that's something that people have created, and that I think informed impact investors are very aware of the choices and the trade-offs that you have to make, and you have to be very, very clear about them. Okay, we have 5 minutes. We have a question up here at the front. If we could grab a microphone, please. Thank you so much. Please.
I'm just curious if there's anyone in the room who's actually received impact investing and what their perspective might be. I understand maybe it's that has actually received the investment.
So is an entrepreneur
an investee and what they think,
what their
because
experience has been?
some of the talk, like, it feels somewhat exhausting because it's like a conversation. I'm looking at all of your titles and and it's like the conversation is within this small portion of who all the stakeholders are. So a lot of it I'm kind of missing. So I'm wondering if there's anyone who's
here who has received impact investing capital and would like to share that experience. We have a couple back here, a couple back there.
Oh, what about Chuck?
I wish we had more microphones. Oh, we have one right there. Do you want to start while we run the microphone?
Yeah, so I think that the asset class conversation is really helpful. I'm an entrepreneur with an investing background, so there's actually a lot of clarity in the investing world on you're not ready for this part of your journey, you're not ready for VC, you should be talking to seed people who are really aligned, and here are the metrics that you need to achieve at each stage. It would be really helpful to have that kind of thing. It sounds like there are some resources that are being developed on that. And not only the segmentation of what types of returns you're looking for, because often it's hard to ask that. And sometimes the investors that I've met don't know themselves. They'll give a reaction of like, oh, we're still experimenting together, which is a fair answer because it's the beginning of this ecosystem.
Yep.
But it would actually be more helpful for us to have that conversation and say, well, actually, what kind of returns are you looking for? Let's map out that journey together. As well as, I don't know how many people attended Clara's delegate conversation yesterday on the asset classes in terms of impact returns. So those are different, right? So are you looking for a proven but incremental impact intervention that is proven, there's research, and then you just want to scale it? Or are we in an experimentation stage where we know that there's a deep behavior change that will happen with our target population, and right now we're putting this money together to experiment with what is going to work, knowing that the outcome that we want.
That's a great point. Thank you. The gentleman back here, sir.
Yeah, I just spent the last month in storming Sand Hill Road looking for effectively a pre-A.
Okay.
So we're at the point where we have technology put in place, the scalability is amazing, our overall potential impact for ecosystem restoration, we're looking at revenues in the 7-year range of, we're going to plant trees with drones. So if we plant 1 billion trees a year, the revenue that goes with that is significant.
Okay.
But where we're at is that we're pre-revenue. We really need to be almost at like a Series A, but even the impact investors are all saying, where's your revenue, where's your revenue, where's your revenue? So what I would suggest is that not just patient capital, but also risk tolerant a little bit longer in the cycle than what you would typically see in a typical company coming to Silicon Valley impact investors.
Super interesting. Thank you very much. Helpful. Okay, so we have time for one more fabulous question. No pressure, but does somebody else have something, or I can throw out a question. One of the questions that I had for all of you really is other areas that we can address, whether it's different kinds of structures that you guys alluded to, the kind of education of both entrepreneurs as well as prospective investors on what they can expect and what they should be expecting from their investments. Are there other sort of solutions to some of the challenges that our speakers have brought up that any of you?
Also, just to add to it, regulation as well. We haven't spoken much about how to tell whether something is being window dressed.
I'm sorry.
Really
could you repeat that for our?
Oh, I'm sorry. I was just going to add to your sort of thought trail and your question, which was just to say that also we haven't talked a lot about regulation and just making sure that actually when we're painting something as an impact investment fund or an opportunity perhaps, that it really is actually going to be impactful rather than just sort of a window dressing opportunity.
I don't know if that's regulation so much. I think regulation is important, but I do think, go ahead, Lisa.
One of the biggest issues that we see with impact investing and investors is trust. And this keeps coming up. We're doing a webinar series on impact metrics, and every time we do it, the questions from the audience is, how can we trust that deal is going to actually deliver on the impact and I think it's related to that. And how do we then create systems or check and balance systems as impact investors? That's things we're working on with entrepreneurs, and we're working on tools, but we haven't really dove into how do we vector to test drive the impact thesis, to track it and make sure that it hasn't wandered away along the path.
The mission drift as well, right?
I think that is a big problem in the industry, and that leads to these kind of worry about impact washing, greenwashing,
etc.
Two T's, trust and transparency.
Trust and transparency. Yes, indeed.
And just a sentence on the policy. So I was part of the National Advisory Board in the U.S. that was part of the G8 process a few years ago, where we set up a task force across the G8 countries to look at what are the policy changes that each of those countries could make to support impact investing. And there's been a lot of progress, actually, on the 7 areas that were defined globally, and then the progress that was made within each country. I think if you look across the 7 or 8, I think 4 of them actually were goals of B-Lab that were then globalized.
Nice.
Right? And so there's just been a tremendous amount of activity, and Bart has been here and on panels and stuff, but the amount of global buy-in to the idea of legalizing purpose has been incredible over the past 2-3 years, and they don't publicize it, they're just doing it.
Yeah.
So there's a lot of progress, as well as, you know, pension fund and other things.
We are at time, Chris, but you have a quick statement?
Just to answer Cheryl's question about regulation, I mean, I don't know about regulation, but I think that there needs to be some sort of voluntary code of practice here, because look, at the end of the day, most investments, just commercial investments, have some sort of social benefit. I mean, I guess I'd ask all of you, I'll pose the McDonald's question. I mean, McDonald's, you know, produces cheap food that lots of people on low incomes eat. Is it a social enterprise? Now, the reason I say it is because, you know, cell towers have lots of benefits. It goes to me, you know, what is the intentionality behind what we're trying to do here? I mean, lots of investments have good benefits. But we need to get to a point where I think there is some sort of code of definition of what intentionality means. That there is an intentionality to pick things where there is a specific intent to benefit a particular group. There is an intentionality to demonstrate that you're then measuring and monitoring whether that impact is being achieved. And there is an intentionality not to exit in a way that causes unintended social consequences. Now, if we work towards that, then you start playing around with whatever instruments appropriate and everything else. And we can fiddle around with that in all the ways that Cathy suggested. But at the moment, the lack of intentionality is blurring this, and we're getting into things where there's a mix of intent and everything else. And that, unfortunately, if we don't control that, is going to lead to a bad reputation, because we'll be judged by the failures and not the successes. So I think that's all I'd leave it, is wouldn't go to...
Work in progress, as you mentioned earlier. I am sorry, I know there's a lot more conversation. They're yelling at me now. So I want to thank our speakers very much. Please fill out your surveys, Thank you guys very much.